Hello there, and welcome to this week's chat between myself and my good friend and resident genius, Ralph Hebgen. Now, before we start, let's just talk through that T-shirt.
Well,
by the way, I'm not a rogue. By the way, I'm not a rogue. This is just a brand, okay? So I'm not saying going around to everyone saying, "Look at me, I'm a rogue." Right? Anyway, sorry. Please go through that. Yeah.
Well, I thought somebody might have just painted that on your T-shirt in expression of his estimation or their estimation of who
you little
are.
Rogue. No.
Anyway, you rogue.
You yeah.
So anyway, this is something which is a blast from the past. I just went through my wardrobe today and I found this T-shirt which we made up ages ago. I don't know, 20 years ago. So when I was working at a now defunct broker, Dresden Klein with Wasserstein, and I was doing some piece on the company which was at the time called Zurich Financial Services, and we then
made a big
3-week marketing tour, and we made up these T-shirts. And basically, I said the company was under reserved, which wasn't that much of a secret, to be perfectly honest. But so basically, we made up this T-shirt, and I sat in meetings with clients.
I just can't believe you did that.
T-shirt.
Yeah,
and
I say
analysts as the DKW says Zurich under reserved, and I thought it was very funny because that's obviously what we were talking about.
Yeah, and I have to say, I say I can't believe you did that, but the thing is, I know you, and I can believe you did that. And I'm sure that actually the clients actually quite liked it.
I only wore it with clients who I knew very well, with whom I was on friendly terms. I wouldn't have gone into a hedge fund.
It's me. It's me.
So Ralph, what do you think of Zurich? Just read it, mate, and then we're off to the pub or something.
Nice. No, that's good. So there we go. So we'd get that out of the way initially, because I thought that people would be thinking, what is this, all the way through. So anyway, right, so today we're going to talk about 3 topics. So firstly, we're going to be talking about Rishi Sunak deciding to stick with EV sales quotas despite pushing back the petrol diesel deadline. Secondly, we'll look at the FCA's imminent launch of an investigation into how private, so that is non-quoted companies, are valued. And thirdly, we'll talk about the increasing need for space insurance. So on the first topic, obviously we saw that Rishi Sunak rolled back various climate commitments, including the one that manufacturers should not sell new petrol or diesel powered cars after 2030. Now that was then moved to 2035 to bring it back in line with the rest of Europe, or should I say these days Europe, not the rest of Europe. And there was a lot of backlash from it. We saw this week we had manufacturers were complaining about it, because understandably, manufacturers have to plan years and years in advance. They'd be planning for this 2030, but that has now been kicked into the long grass into 2035. So they were understandably annoyed. And we ourselves said in our recent talk that it was kind of ridiculous. Wouldn't it be ridiculous if the government said that the car manufacturers still had to sell a certain the majority of their cars had to be electric by 2030, and not pushing that out to 2035 as well? Well, guess what? They left it unchanged. So I argued you've got the worst of all worlds here, from the manufacturer's point of view, because they still have to they're still going to have to sell the majority of the fleet that they sell is going to have to be electric vehicles. Otherwise, they're going to be absolutely massive crippling fines, I would suggest. So they're going to have to. So they're still going to have to stick to that. But at the same time, there is less of an incentive for people to buy electric vehicles sooner rather than later, because they've got another 5 years. So anyway, so that, I think, is very tricky. But what do you think, Ralph?
Well, I think the same thing. I find this situation rather farcical, to be perfectly honest. I
Mm.
mean, last week, I basically commented on the same thing, and I basically said, or basically last week, I mean, you guys can actually listen to that if Peter ever gets around to actually publishing it.
Yes, I will
Yeah,
do.
right, cool.
Yeah.
So basically, you can
That'll be just
basically
before
listen
this
to
one.
what I said
Before this
last
one.
week, and then
Yeah.
compare it to what I
Yeah.
said this week,
Yeah.
and then you'll probably find that I entirely contradict myself.
Yeah.
But hey,
That's right. They'll realise all the holes in the arguments. But anyway,
maybe I can make up a T-shirt
yeah,
about just basically saying what I'm saying now.
yeah.
Anyway, so last week I was talking about this as well, and we were saying that Sunak was able to actually get some benefits to the sort of general public. And I was saying, if you're, for example, a plumbing business or whatever, and you have vans which you need to replace, then now you don't need to replace them by 2030 at the latest, but by 2035 at the latest. And that gives you a little bit of a window. Listen to my comment, then I'm not going to repeat it all. But basically, that is a good thing. But at the same time, you would have thought, or I would have thought, not knowing what I know now, that the government would then also align their regulations put on car manufacturers with that newly delayed target of 2035. And in the event they have not done this, so this is a staggered demand of how much car manufacturers have to put out in terms of electric vehicles, and it goes up in steps, reaching 80% by 2030. So in other words, by 2030, a car manufacturer needs to manufacture 80% of their output as electric vehicles. And as you said, I mean, as originally planned, people would then be there to buy them because there is nothing else there. But now people do not have to buy them until 5 years later. The timeline here is 2030. I'm sort of looking at the year 2030. And manufacturers are obviously incensed about this, and rightly so, because they now have to stick to a manufacturing schedule, which from their point of view, they can no longer expect to be met by demand. And also, of course, there are other things like the support structure for these electric vehicles. They need to be charged. And the car manufacturers produce the vehicles. They don't produce the charging stations. So the charging station industry is also in a strange limbo. Probably they will fall in line with the manufacturing industry and offer the charging stations required by 2030, but arguably they might actually have a little bit more window as well, because they know full well that the real target now in terms of the demand is going to be 2035. So everything is a little bit muddled here, and well, I don't want to steal your thunder, Peter. I think you have a theory here of what.
Yeah. Right. I do love a conspiracy theory, right, or a contrarian thing, but this is just an opinion, right? But I think that this is all about the election. I think that giving consumers time at a time when they are feeling, their household budgets are being squeezed, I think that allowing them, giving them more time to maybe build up cash to buy an electric vehicle is going to be popular with the electorate. On the other hand, the environmentalists are strongly critical of this pushback to 2035. So what I think is that Sunak has done this to appease the consumers, but also to a certain extent not lose the environmentalists completely, because I think that it's the sort of thing that he can change quite easily after an election if he is re-elected. So, for instance, he says this now. It's okay. It's still 2030. Everyone, all systems go. I wonder whether the government is maybe hoping that, in fact, the charger network grows better than expected. More people still buy electric vehicles because there are more attractive vehicles coming online. So there's that. So actually, 2035 may be academic, and in fact, it may work itself out by 2030. So they're sort of gambling with that, and the fact that they could, they could, or they could. It's something that they could change when they get, when Sunak gets re-elected. Say, look, actually, we've had to think about it, everyone. We're just going to have to roll it back and make it 2035. So,
Yeah.
well, I think if he'd have pushed the other one back to 2035, he really would have lost the all of the environmentalists, if you like, or made them more, against the government. Whereas this is sort of in the middle, and again, I guess it throws the ball in the court of the opposition potentially to put pressure on them.
It's possible. If what you're saying is true, or if there's some validity to your theory, it would just simply highlight the difficult spot in which the Tory government finds itself at the moment, because you have to gamble in this fine-tuned way, and you have to walk a tightrope between garnering support from the general public and not losing or not aggravating the environmental lobby any more than you have done already. Then it sort of shows that there is very little maneuverability space, very little flexibility for you. And that's probably the reality of it. But I don't really know. I wonder what is behind it. It may just be poor planning in the end.
Yeah,
tell
exactly.
you the truth. And because the environmental lobby is going to be very unhappy with this anyway, and is of course vociferously against this. And the situation may just be that we're going to get more overt activism against the government than we have already. I mean, we have I keep forgetting their name. Last Generation. I think that's in Germany. Extinction Rebellion. There we are.
Yeah.
Oh no, it's Extinction Rebellion, but there's a splinter group which has split off from them, which is Just Stop Oil. There we are.
Oh yeah, okay, yeah.
And these guys, they glue themselves to the street and help the environment in that way. So you can probably see what I think of that just by the subtext here. But that must help the environment, so that makes a lot of sense. But I mean, my personal opinions aside, whether it makes sense or it doesn't make sense is not the point. The point is that there is a clear, vociferous voice in the public against the way in which environmental policies are being implemented, and they find their way in, I would say, violent activism, and that's not going to go away. That's going to get worse because of policies like this. And then you have externalities, which is the sort of cost which arises, sort of, which you wouldn't have in an economy if it was normal cost of business. So these kind of people, this kind of activism is going to increase this cost, and this might actually backfire as well. So I don't really know where I am on this. I just record the difference here between the two policies. On the one hand, to push the target back, on the other hand, to keep the target at bay in terms of the for the manufacturers, and that's not going to, in the end, that's not going to be positive for the Tory government either, because clearly the manufacturing lobby is powerful, and I think, I don't really know where it might actually come out as a net loss, having said last week that it might be actually a net benefit because you get the voters on side.
Yeah, no, fair enough. So there we go. So more about Sunak this week. So let's move on to the second topic. So this was one of those stories that this week I thought, shall I mention it? Because I wonder whether people are actually going to be even vaguely interested in it. But I thought, do you know what? It is actually very important, right? So this is about the FCA looking into how private companies are valued. Now, I suppose you could put in context, OpenAI, for instance, is looking for a $90 billion valuation. Now, how do you actually value a company that is not quoted? It's more difficult to do because it's not as open with all its assets, etc., that, say, a quoted company would be. But the idea is the FCA thinks that, or the implication is that they think that these private valuations are based on fantasy, and that they need to bring a bit more reality into the mix to make sure that investors aren't hoodwinked, essentially.
Yeah.
So now I think that this sounds like it would be good. It does. I think it merits investigation, but to my mind, it's hard enough valuing a quoted company. Not that I know, because I haven't done it. Obviously, you've done it a little bit more than I have, and so how are you going to do it for a private company? So what do you think, Ralph?
I'm shrugging my shoulders. I mean, if you do, you can, okay, there are various ways to attack this problem. I mean, one obvious pragmatic way is to say, if Microsoft purchases a 50% stake in OpenAI, I can't remember what they paid for it, but 30 billion or something. What is it? Was it or 20
I've
billion or
forgotten
10
it.
billion?
Yeah,
Let's say 10 billion.
Billions. That's what
Let's
it is.
say 10 billion. It's just an
Yeah.
illustrative example. Then
Yeah.
obviously, so my example was if they buy, let's say they buy 10% for 10 billion, well that would value the company at 100 billion. That's just an implication of what just happened. I mean, if 10% is worth 10 billion in the mind of Microsoft, and it clearly is because they've given you 10 billion, that's the real worth, that's the real money, then it follows that 100% must be worth 100 billion. And so that's one way of doing it. But that's not really talking about the value of the company, because the next step would be to ask yourself, okay, that's the implied valuation, implied by the action of one investor. But what is a company valuation? What does it actually mean to value a company? Well, it means that this is the sort of money which somebody would give the owners if they wanted to purchase the company. So there has to be a link between the profitability of the company and the value, the assessed value of the company. And of course, this is a science in itself. People study this at university and business school. It's corporate valuation and it goes on forever. But in the end, what we can say, for example, simplistically perhaps, but certainly evocatively, there has to be a link between the post-tax profits which the company is deemed to be able to generate every year over a future sustainable period of time and the value of the company. And so if the company, let's say, generates 100 in earnings means post-tax profits. In earnings, this year, and I think that the company can do this every year for the next 10 years. Then in a simplistic valuation, I can see, well, I add it all up, and that's 1,000, and that's kind of my value. That's not going to happen in the real world. You do it differently. It's a present value, and there's technology there, and etc. But essentially, I just wanted to highlight that there needs to be a link between the profitability of the company and the value which is assessed the company to have. Implied valuations of the nature which I have recently alluded to don't necessarily do that. If Microsoft comes in with 10 billion for 10%, yes, the implied valuation is 100 billion. But what does that actually mean? If I now take this second layer of attack, which I have just outlined, and I can then say, okay, what does 100 billion actually mean in terms of the post-tax profits? How much of a multiple would that imply for post-tax profits? And if this multiple is ridiculous, like 100 times, for example, then I would have to say, as a rational observer of the financials of this company, this is an unsustainable valuation. Microsoft have gone in and they have been happy to pay a lot for a stake in their assessment of the future earnings capacity of this company. But it's only one person, one company, one agent who evaluates this, and it may not reflect the actual reality of what this company will be able to generate in earnings in future. And if you then see, you being the investment community in general, that this is not going to happen, then of course the value will plummet. This is going to be less of an issue for private companies because they are not quoted, and so therefore there is no quoted value. There's no share price to reflect this sentiment in this way. There's no quoted share price to plummet, but obviously you would then have, you now being the company, let's stick with the example OpenAI, would then have limited options for the future. If they wanted to take on another investor, for example, they wouldn't pay the same money for another 10% stake because in their estimate, the valuation of the company is inappropriately high. And so this is sort of how this works for private companies. But obviously, private companies, even private companies, have got accounts. It's just that they are not public accounts. So if you are being taken inside the company and you are tasked with, for example, an investment bank preparing an IPO, you are tasked with putting a value on the company, then you will have access to the financial information of the company. And then you would actually look at the financial information in context and put a value on it from first principles. And this is, I think, where, however, the FCA basically comes in. They would want to somehow put a framework on this precise process. When you are inside the company, when you have access to the financials of the private company, when you put a valuation on it, I think the FCA would like to limit the subjectivity or the opinion flexibility which you have as an investment banker when you evaluate this. Simple example, I'm making this up. One like I might, for example, say, "Ooh, this is fantastic business. This is going to change the world. It's going to have 30% earnings growth in the future, and I value the company like this, and I get a fantastic multiple and a very high valuation." You might come in and you would be much more pragmatic than I, and you think, well, what Ralph is thinking, this is like a tech fantasy, and he loves this kind of stuff. He used to read science fiction when he was 14. I never did, so I'm much more pragmatic. I don't think 30% earnings growth is anywhere near what this company is going to make. I'm going to say it's 10%, and so my valuation is much lower. And I think the FCA wants to actually institute some sort of framework which limits the extent to which individual agents, individual institutions which are tasked with the valuation of these companies can just basically invent any assumption they want.
Yeah, I mean, it's it's crazy, isn't it? I mean, I think for a lot of people, eventually, I suppose they go on feel, don't they? Really. I mean, you take the valuations as much as you can, and you maybe compare. I mean, to get to the valuations, you probably compare what something similar, what that is valued at, and then you plug that in. But when it's something like AI, which is really very difficult to pin down, it's very hard, and I think that's when you start getting fantasy valuations. People just saying, "Look, doesn't really matter. This is going to go to the moon. Everything's fine. Just get involved." I mean, I always think that actually this is more for quoted companies, but I always think that a sign that reality has long gone is when analysts invent a new way of valuing a company. So they come up with it's like you say, if you can't score enough goals, just change the goalposts. And that's what often happens. So I'm always incredibly suspicious when you hear, oh, there's this new there's this new way of measuring the value of a company or whatever. You sort of think, well, hold on a minute, is there a reason for that? Yeah, but
this is a bull market mentality. When I was starting out, when actually at the time we were at the same company, there was a company quoted in the US, and its valuation was very high. And analysts did precisely this. The US analysts came up with a valuation methodology whereby they said that given the technological advantage of that particular company, they might come up with products in the future that they don't even know they are able to develop at the moment. And those will then generate earnings. That's a very long way of saying, let's just put a higher number here. This is exactly the same.
Yeah.
And of course, the regulator at the time didn't really sort of look at this at all. Now, the thing is, private company, when an investment bank is tasked with going in and valuing this is only for one reason. The company wishes to actually become not a private company, but an IPO. They wish to be quoted on the stock exchange. And then, of course, you already have a process which limits to some extent an arbitrary valuation, because this is not done just by one investment bank, but by many investment banks, the so-called syndicate. And they may be 3 or maybe 5 lead banks in this syndicate, and it is beholden on these banks to submit valuation reports. And these valuation reports, well, obviously they value the company, that's the task, and they have become a lot more regulated, I would say, certainly regulated as to what you can say in these reports over the years. When we started out at the same company, whenever that was, actually 30 years ago, this is how old
I was only 5 at the time. I was an absolute I was a child genius. Yeah.
Oh, I was already 50 at the time. Excellent. It was quite. I had a lot of freedom. I could basically use my creativity in the way in which I valued the company which I did value at the time.
When you say that, do you mean that you got a special valuation dartboard out and you just threw those darts in there, just to get some?
No, that's a stochastic process.
That's it. Okay.
That also exists. I don't wish to talk about it.
So, how much is this? How much is this valued? Hold on a minute. I'll just get this dart. Hold on. Yep. I think that's about 180 million pounds.
Would have probably been more accurate than my valuation. Actually, I mean, there is famously the experiment to have monkeys throw darts at the financial pages of the Financial Times, and
Excellent.
then basically pick those values and put them into a portfolio.
Yes.
And we would all, of course, want that portfolio to perform much worse
Mm.
than that of professional fund managers.
Yes.
I leave you to think
Who won? Yeah.
whether it did or not.
Yeah. Well, this is the thing. So when I was actually, I can't say where I was working at this and who was involved, but there was quite a controversial salesperson. He was really good, really intelligent, and everything. He used to put out these amazing notes, and when you were allowed to do that sort of thing. And he was a constant thorn in the side of the Japanese management at the time, because he used a mechanical toy monkey to choose. So he was choosing basically Japanese stocks. They have these numeric codes, so they're 4 numbers, right? And that, that's the identifier. And I've forgotten how he did it, but he got this monkey to choose like a portfolio of 10 companies using this monkey. And he used to this. I mean, you really can't get away with doing this normally, but this guy could get away with all sorts of things. He used to put in his notes to his clients how the monkey performed versus the analysts, and it got so bad that the analysts would get really nervous by the end of the year, because if the monkey was performing better than them, the boss would notice. So yeah, it was so funny. But yeah, that's sometimes, like I say, at the end of the day, right, with all this, it's with valuations, it's your best guess. I mean, there's certain things that have an actual value, but then there's others where you think, well, how do you value that? So
I mean,
yeah,
yes, but let us not be overly dismissive. There is
no, I'm not
a
being.
lot
I just thought it was funny. That's the
science
thing.
here, and the FCA, I think, wants to limit the extent to which the monkey does these valuations.
Yeah.
Because, we can't talk about this, of course. This is something which you learn at university, and it's quite difficult. But I'll just give you one example. For example, this: if you increase, if you value a company using cost of equity, then according to the capital asset pricing model, the cost of equity is based on the formula that you use the risk-free rate plus something times the equity risk premium.
Which I think is something we all know, right?
Yeah, I'm just spooling it down so that you get a feel for the technicality of this.
Yeah.
The something is the beta. The beta is a correlation coefficient between what the company does and what the market does. Now, this is all good. Would debt come in? Yes, it does. If you have a higher debt quantity in the company, then the debt to equity ratio actually means that you have to adjust the beta. You have to adjust the beta using the debt to equity coefficient in a particular way. There's a formula for that. And I kid you not, there are not that many people in the analysts community who A, know this, and B, do it. And that is one way how valuations can differ. If I value one company which has a debt to equity coefficient of something very large, and then I value another company which has no debt, and I use the same cost of equity, where the beta is unadjusted, well, then the result is not going to be right. But it is not going to be not right because some woozy assumptions which you can make or you can't make, or the monkey might have done better or worse. It's because the science wasn't followed in the valuation. Once you follow the science, well, then you can actually talk about the variability of the assumptions around it and the sensitivity of your results. But you can only do it then. And if the FCA plans to maybe look at analysts, models who value companies in this way to just see whether, for example, the beta has been adjusted in light of the debt to equity, or whether people do something completely silly. There are numerous examples. They're all very technical. I mean, I had questions like, for example, there's another formula which is known as the sort of growth formula, which is a quotient, return on equity minus growth, and in the denominator you have cost of equity minus growth. This is, I see you smiling, but this is completely standard. I mean, everybody knows about this. If you don't know that formula, then you should really be out
I
of
talk about this all the time. I mean, yeah.
No, I'm just saying.
Yeah.
So,
I know.
so yeah. So the question there is, I'm not going to go into technicalities, but somebody asked me something about this formula, and I said, well, in the circumstances which you just outlined, this formula doesn't exist because it's not defined. The series on which it relies diverges. And the person just looked at me as if they had never heard that before. You can only sum the series and then summarize it into this particular quotient if the series converges. You can't do it if the series diverges. Again, a lot of people don't know this. And so I'm coming over like a little bit glib here. But the point is, when I hear a salesman talking about the monkey doesn't know any of that. The monkey comes up with results following a completely stochastic process. Yeah. Sometimes they will outperform the analysts, sometimes they will not. Before I have a time series of 20 years seeing how the monkey performs versus the analysts, I cannot say that the monkey does better unless I know that they systematically do better. And I wouldn't necessarily say the monkey will not do systematically better. It's possible, I don't know. But back to the news story, I think that perhaps there is also what is perhaps needed is a little bit of almost like a quality control of the knowledge of the analyst which goes into the building of the model. You know the old adage, all models are wrong, but some are useful. I mean, that's true, but some models are wrong because they're incorrectly built, and that can't be right. I mean, you have to make sure that the right technology is implemented, and in the second step you can then talk about the assumptions which have gone in, and that to that extent I think this may actually be a sensible probe. But there's also a cutoff point. If you force people to be too beholden on a preconceived framework, then then you're not going to be able to find a range of market valuations which are interesting. For example, if you would say, well, a tech company, absurd example, you can never price in more than 15% earnings growth or whatever. Not that the FCA would do that. I'm giving an example of a deliberately absurd way of doing this. Then obviously you would choke off the outcome, the sensible outcome of valuations as well. So there's a fine line in the middle. But from my experience of what analysts' models can be like, mine included, I would say that's probably not a bad probe if it doesn't go too far.
Yeah. So we'll see what happens. I mean, like I say, I think that it needs to be done, but it's kind of, how's it going to be implemented, and
exactly.
that's really difficult, I think.
And also, does it make the process excuse me, too onerous? The more cooks there are, the less good the dish is going to taste. And that's true. I mean, already now there's a lot of regulation which needs to be observed. I can't just write anything. There is already a lot of regulation. Then it needs to go to the lawyers, then it needs to go to the bankers and to the company, and etc. And I think there is a lot of regulation already enshrined in the process of bringing a company to market in London, which has recently shown up as perhaps overly onerous relative to the New York Stock Exchange, which is one reason, I think a minor reason, but still a reason why we appear to be losing lots of IPOs to the US currently. So let's be careful what we wish for and make things even more bureaucratic and difficult.
Yeah, fair enough. Okay, so let's move on to the final topic, and this is the increasing need for space insurance. Now, I think I've seen recently how a couple of big law firms have launched space. Sorry, I only just thought of that. And they just launched their new space divisions. And I mean, obviously, they're doing that because they see the need to do that. I think that when particularly with these low orbiting satellites, the fact that these are going to become much more prevalent over the course of time. Even just that, there'll be those satellites. There'll be satellites as part of defence, systems and all that kind of stuff potentially in the future. Insurance is definitely needed, but yeah. So I thought that was interesting that we're seeing this. But I mean, you've got some very interesting thoughts on that as well.
Well. Space is pretty cool, isn't it?
Yeah. It's the final frontier, apparently.
It is indeed, absolutely. To boldly go.
Yeah.
I mean, most of our listeners are going to be far too young to know what any of that means.
Yeah.
It's all naff and horrible.
It's almost like it's in a universe far, far away, isn't it, really?
God. Yes, it is indeed quite so.
Yes, still got it.
Remember, Donald Trump in his first and I hope only legislature period actually established a space force.
Yes.
Right, cool. Moving on. Cool. So what we're talking about here are satellites. And there are different satellites in different orbits. There are geostationary satellites, which are just basically in the orbit of the Earth, and as the Earth turns, they sort of stay there. So they are stationary in orbit, and these are the sort of things which you use for GPS and stuff like that. They are higher in orbit than the so-called, what are they called? Low Earth orbit satellites. And they are also more expensive. So the insurance value of one of these geostationary satellites, is typically like $250 million, something like that. And the insurance value of one of the LEOs, the lower Earth orbit satellites, is sort of in the region of $500,000 to $1 million. So that's the sort of order of magnitude we're talking about here. So that's point number one. Point number two is, and I think I'm right on this, I would need to fact check this, but I'm pretty sure that this sort of space debris, which has recently made headlines, is sort of, well, it's caused by the LEOs, and it's therefore sort of in the order of the distance from the Earth where the LEOs operate. Now, that means that there is more risk of collision for a lower Earth orbit satellite than there is for a geostationary satellite. And as a consequence of that, it is not just that there is a larger risk, but the risk is also more difficult to quantify. Which means, and this is in insurance always the case. I mean, if you can't quantify a risk well, then you don't know what to charge for it. So that's the reason I think that about 50% of geostationary satellites, I don't know why I do this. I mean, it's just indicate a high orbit.
Yeah.
So why 50% of geostationary satellites are insured, but virtually none of the LEOs is insured. I think there are about 6,000 LEOs, and about 60 of them are insured. And so the reason is one reason for this is, I believe, that it is more difficult to calculate the risk of the risk of damage, the risk of collision for the LEOs. But there's another reason, that the LEOs are not very expensive to build, and there is an inbuilt redundancy in these. So Elon Musk, I think he doesn't care very much if he loses 1 or 2 or 3 of these, because when he launches them, he launches 10 at a time, or maybe even more. And if 3 of them are taken out by some refrigerator which might be floating around, or whatever the space debris is which we encounter there, he doesn't really care. And so, in other words, it's partly that these are deliberately left uninsured, and partly that the risk is more difficult to calculate. So that's the situation at the moment. But obviously what we're having is that as we launch more and more of these LEOs, by the way, what these do is communication. These are mostly communication satellites, also spy networks and things like that. So as we launch more and more of these, the risk of collision is going to be far greater, and eventually there's going to be a tipping point when we have to decide what to do. Either siphon off all this froth of rusty old satellites if we can, but that's hard to do technologically, or in fact to start insuring these satellites. So then the question becomes, well, what do we charge for them? We being the insurance industry, what premium do I put on the risk? And well, there is always a mathematical way to calculate this and a commercial way, and the two sort of don't necessarily go together. So if an actuary in the back chamber so calculates the risk and then comes up with a theoretical premium that they ought to charge, then the next thing what you need to do is to actually see whether the market is good enough to actually deliver this premium. And the market for space satellites is linked to the aviation markets, and aviation rates aren't very high at the moment, and so there is a disconnect, I think, between what you ought to charge and what you can commercially charge, being a third reason why the LEOs are sort of left uninsured. And yeah, so there will be a tipping point. I don't know what's going to happen. It looks to me as if this is an industry from the point of view of the insurance industry. It's a sector which is going to be developed as we get more LEOs into orbit still, and also importantly, as we are beginning to see that the space debris is going to start being an issue, an obstacle for other technological projects which we wish to do. For example, launching space probes which land on asteroids. We don't want to be hit. The Earth doesn't want to be hit by or Cephas or whatever the thing is called, which is going to hit or just not hit in 2029, but it's coming back in 2034. So we better know what we're doing here. Or of course things like space missions which go to the moon and from there to Mars. I mean, this is all the sort of docket of NASA is quite full for the next 20, 30 years. And if these various space missions which NASA is planning are beginning to be impacted by the ever-densening shell of space debris which is encircling the Earth, then I think insurance is going to become a lot more even of a necessity than it is now. And when this happens, then there will be a rate and a price for these risks, which is a commercial rate, which is going to develop in the market. And it's not as if the space insurance industry is not well developed. I mean, we're not talking about small specialized companies. We're talking about AXA XL to be precise, but that's a That's a subsidiary of AXA. We're talking about Munich Re, Swiss Re, Lloyd's of London, and the London market. So the companies there are well established and they know what they're doing.
Superb. It's really, I think it's a very interesting area, and obviously something that is going to grow. I would think, I mean, it seems to me there's a huge potential for it to grow for a number of reasons. So yeah, I mean, I think that.
So if we were to work in the space,
yeah,
the space,
yeah.
then we would have our drinks at the restaurant at the end of the universe.
There we go.
And
Another good
everybody
reference.
is going to think, what
are they
on
talking
earth
about?
is he talking about? And those people who know are thinking, Ralph, you are so dad's joke. That's so old.
Absolutely. I mean,
so sorry.
In terms of the scope of upsides here, I mean, I think you could say that it is, could be to infinity and beyond. So yeah. So anyway, on that note, we'll leave it there. But yeah, some really interesting stuff this week. I mean, there's always interesting stuff. I mean, that's the beauty, I think, of what we talk about, is that there's always something. There's always something going on in the world that is worth talking about. So, so we're very lucky in that.
And sometimes it even gets published.
Yeah. Okay. Don't worry. It's going to get done. Anyway, thank you very much indeed. On that note, have an absolutely lovely day, evening, weekend, whatever it is you're up to. Depending, yeah. And we will see you again. Should be able to see you again next week. So many thanks.
Thanks everybody for listening. Thanks, guys.